Morning all. Welcome to our first quarterly financial reporting update of 2018. The session is intended to take no more than about 40 minutes, including questions. And your presenters today are myself, Vanessa Lee, and my colleague, Brian Crichton. We're going to be looking today at events since our last update in November 2017. So we're going to start by looking at the revisions to IFRS 102, which were issued last December. And although these are not mandatory until 2019, many companies may find it beneficial to adopt them early. Then we're going to look at a reminder of some of the transitional considerations relating to IFRS 9 and IFRS 15, and also the disclosures around those standards that the Financial Reporting Council, the FRC, is expecting to see as noted in their thematic review announcements. Finally, we'll cover a news roundup, in particular looking at the Financial Reporting Council's thematic reviews, both those reports they've published in 2017 and what is announced for 2018. And these build on the year-end reminders that we covered in our November webinar. We looked in our last webinar at government's intention on corporate governance for both listed and unlisted companies. And since then, the FSC has issued proposed changes to the UK Corporate Governance Code, so we'll touch on that. In addition, the AIM rules have been revised to require more disclosure, although not in the annual report, around corporate governance. And finally, we'll take a quick look at some changes in US federal tax, which will be of relevance if you have a US tax presence. So to start, I'm going to cover the revisions to IFRS 102. So last year, the FRC published amendments to IFRS 102 following its triennial review in December. These had previously been issued as the exposure draft, FRED 67 for the triennial review, and also FRED 68 for the tax effects of gift aid payments. The principal effective date for these amendments is accounting periods beginning on or after the 1st of January 2019, with early application being permitted, provided that all amendments are applied at the same time. The only exceptions to this are the amendments relating to the director's loan and the tax effects of gift aid payments, for which early application is permitted separately. There are also limited transitional provisions available, and so we're going to touch on some of these in the following slides. So, just to run through what the principal amendments are. The amendments confirm the simplification of the measurement of directors' loans to small entities, following the interim relief granted in May last year. Indeed, the final simplification is actually slightly wider than the interim relief was. The other principal amendments to IFRS 102 are largely as we have previously publicised. The amended standard requires fewer intangible assets to be separated from goodwill in a business combination, permits investment property rented to another group entity to be measured by reference to cost rather than fair value in the lessor's financial statements, expands the circumstances in which a financial instrument may be measured at amortised cost rather than fair value, and simplifies the definition of a financial institution. It also provides relief from recognising tax payable when a trading subsidiary expects to make a distribution of the gift aid payment to its charitable parent. So now I'm going to look at each of these in turn. Okay. So looking first at small entities. So for small entities, the revisions introduce a more proportionate accounting solution for a loan from a person within a director's group of close family members that includes at least one shareholder in the entity. The new rule will permit the loan to be initially measured at transaction price rather than fair value, present value. And this extends and replaces the May 2017 interim relief that was previously available where the director and shareholder were the same person. But under the final amendment, the director, shareholder and lender could be three different people, provided that they are all members of the director's close family. In this context, a director's group of close family members shall be the director and the close members of the family of that director. And IFRS 102 defines close members of the family of a person as those family members who may be expected to influence or be influenced by that person in their dealings with the entity, including, but not limited to, that person's children and spouse or domestic partner, children of that person's spouse or domestic partner, and dependents of that person or that person's spouse or domestic partner. This includes a person who is, for example, a sole director shareholder of an entity. The loan is then subsequently measured at amortised cost using the effective interest rate that is implicit in the contract, which may be zero. There are, however, no exemptions for loans made by small companies, including intragroup loans and loans to directors or shareholders. Also, a loan from a director who is not a shareholder and has no close family members that are shareholders will not qualify for the relief. If the company ceases to be small, then it must revert to the normal approach of recording the loan on a discounted basis. But when remeasuring the financial liability to present value prospectively from the first reporting date after it ceases to be a small entity, it may determine the present value on the basis of either the facts and circumstances existing at that time or the date the financing arrangement was entered into. So a bit of a choice there. An entity that was not small when the loan was advanced but subsequently becomes small and eligible to take advantage of the exemption and chooses to do so shall apply the exemption retrospectively. Another amendment is around business combinations, and the proposed changes to business combinations have flowed through unchanged into the revised IFRS 102, which requires entities to recognise intangible assets separately if they meet the recognition criteria, they arise from contractual or other legal rights, and they are separable. However, it should be noted that entities can still opt to recognise intangibles acquired separately from goodwill, provided they meet the recognition criteria and they are either separable or arise from contractual or other legal rights. So, for example, they only meet one of B or C on the slide. When an entity chooses to recognise such intangible assets separately from goodwill, it will be required to apply that policy consistently to the relevant class of intangible assets across all business combinations. And this change to recognition of intangibles on a business combination is not a retrospective change and will be applied prospectively. Comparative information is not restated, and a company cannot subsume within goodwill any intangible assets that previously they've separately recognised. So, for example, if you first adopt in the financial statements for the 12 months to 31st December 2018, then business combinations that occurred in 2017 and prior periods would not be restated to subsume any intangible assets into goodwill. The FRC considers that examples of intangible assets that would normally satisfy all three criteria would include licenses, copyrights, trademarks, internet domain names, patented technology, and legally protected trade secrets. And the examples of intangible assets that would not normally satisfy all three criteria include customer lists, customer relationships, and unprotected trade secrets, such as secret recipes or formulas. And no contractual or legal right exists that would give rise to expected future economic benefits. Again, for intragroup investment properties, the proposed changes have flowed through pretty unchanged into the revised IFRS 102. So an accounting policy choice is now available for entities that rent investment property to another group entity, whereby the lessor can choose to measure the investment property either as PPE at cost, less any depreciation or impairment as appropriate, or as an investment property at fair value through profit and loss. Transitional provision will permit the lessor company to use the fair value at the date of transition to the revised IFRS 102 as a deemed cost. So, for example, if it's adopted in December 2018 annual accounts, the company would use the fair value at the 1st of January 2017, the beginning of the comparative period. If a company goes down this deemed cost route, the deferred tax implications for the revaluation, which is included within the deemed cost figure, would still need to be accounted for, and to comply with the alternative accounting rules requirements of the Companies Act, a revaluation reserve would need to be shown for the revaluation amount that had not been consumed by depreciation, and the additional disclosures required by the Companies Act regulations must also be given. Another amendment in IFRS 102 is to introduce a description of a basic financial instrument to support the detailed conditions for classification as basic. Making this change will result in a relatively small number of financial instruments which breach the detailed conditions for classification as basic, now being considered to be basic and therefore measured at amortised cost. So in these cases, measurement at amortised cost will provide relevant information for users of the financial statements. The description has been added as a new paragraph along with some new examples, two of which illustrate the use of the description. The loan with interest payable at the bank's standard variable rate plus 1% throughout the life of the loan, where the bank's standard variable rate is negative. Another where a loan with a condition that the interest rate is reset to a higher rate if a set number of payments are missed. Some other new examples include early repayment of a loan is not permitted during an initial 2-year period but is thereafter, early repayment on subordinated debt contingent on repayment of senior debts, and a loan with interest equal to a percentage of the profits of the issuer. Some other amendments to IFRS 102 include further guidance on how to determine whether an entity is acting as an agent or a principal was inserted into Section 23, and this was following feedback that the standard was not sufficiently clear. The additional guidance is based on the guidance issued in IAS 18 revenue. IFRS 102 was also amended with the insertion of paragraph 22.8a into the liabilities and equities section to give the exemptions similar to those in IFRS for transactions that would not be within the scope of IFRIC 19, such as transactions with shareholders as shareholders and common control transactions, or the conversion of convertible debt. Key management personnel disclosures, the requirement here has been retained, but an exemption has been introduced for entities when there is no difference between the key management personnel and the directors. So an entity that has key management personnel that are not directors will still need to disclose the total key management personnel compensation, including that relating to the directors. And this is to avoid overlap with the Companies Act requirements. The definition of a financial institution has been amended to remove references to generate wealth, manage risk, and stockbrokers. These amendments will reduce the number of entities defined as a financial institution, and as such, this will mean that these entities are no longer required to include additional financial instrument disclosures within their financial statements. However, it must be noted that the revised 11.42 now states, when the risks arising from financial instruments are particularly significant to the business, for example, because they are principal risks for the entity, additional disclosure may be required. The paragraphs in Section 38 for financial institutions set out disclosure requirements for those financial institutions and include examples of disclosure requirements for risks arising from financial instruments that may be relevant in such cases. Some of these disclosures might need to be retained. For trading subsidiaries of charities that gift aid profits to their charity parent, a pragmatic exemption has been made to Section 29 income tax to permit the tax effects of the gift aid payment to be taken into account when it is probable that the gift aid payment will be made within 9 months of the reporting date, even though the distribution itself cannot be accrued until it is a legal obligation. Now, this one is consistent with the way in which the gift aid relief works for corporation tax purposes, in that relief is provided automatically against the taxable profits of the previous period when the gift aid payment is made within 9 months of the reporting date. In addition, an amendment has been made to Section 29, Income Tax, to clarify that the tax effects of distributions to owners shall be presented in profit or loss rather than the same component as the underlying transaction was presented. I'm now going to hand over to Brian for an update on IFRS 9 and IFRS 15.
Thank you, Vanessa. Well, 2018 is now upon us, and companies will be adopting IFRS 9 on financial instruments and IFRS 15 on revenue from contracts with customers, both of which apply to periods beginning on or after 1 January 2018. Of course, it's not just the December 2018 annual financial statements that will be prepared under these new standards, but also the June 2018 interim statements. Obviously, if you're not at December year-end, the annual and the interim dates will change accordingly. We've spoken previously about the FRC's expectations for the disclosures of the effect of the new standards in the final annual accounts before they are adopted. So if you're adopting them in 2018, the final annual accounts before will be the December 2017 ones. The FRC was disappointed by the results of a review on the disclosures in December 2016 accounts and expect companies to include detailed quantitative disclosure of the effect of the new standards in their final accounts before implementation. So basically, they're expecting a step change in disclosures for December 2017 accounts, disclosing what the impact will be of IFRS 9 and IFRS 15. They go on to say this will be particularly important to provide meaningful and clear explanation of expected changes, where disclosure of the impact of the new standards provided to date has been limited. However, more recently, since our last webinar, the FRC has also announced that they will be monitoring companies' disclosures of the impacts of the new standards in interim accounts issued in 2018. So when companies issue their June 2018 accounts, those will be reflecting the accounting required under IFRS 9 and IFRS 15, but the FRC has now set some standards they expect to be met for the disclosure effect. IAS 34 requires a company to describe the nature and effect of a change of accounting policy. The FRC has said that they expect that disclosure to give quantitative disclosure, to be accompanied by informative and detailed explanation of the changes tailored to the company's specific circumstances and transactions. Any key judgments made by management in applying the new standards and methodologies are to be clearly explained. And also, there should be an explanation of how the transition has been implemented after giving careful consideration of the transitional disclosure requirements under the new standards and requirements of IS 8. The FRC went on to note that some companies, such as those listed on the AIM market, are not required to comply with IAS 34. However, a discussion of the nature and effect of a change in accounting policy is necessary for all companies in order to provide meaningful information to readers of their interim accounts. So that's touching on the disclosures required in the last annual accounts before implementation and in the interim accounts having implemented. What I want to do now is go on and give a bit more detail about what you might disclose in your last accounts before implementation. So, for example, in your December 2017 accounts. The FRC have said they require qualitative and quantitative information relevant to the company and practicable to disclose. So you might consider disclosing the effective date of the standard, where relevant, when the first interim accounts will be prepared in accordance with the new standards. Entity-specific descriptions of the changes introduced by the new standards. Try to avoid merely repeating the requirements of the standards and giving boilerplate disclosures and targeting changes which are specific to your company. Where there's a choice of transition methods, which will you be adopting and are the practical expedients you'll be using? And the amount and nature of the expected effects compared to previously recognised amounts. Even if it's not possible to give comprehensive disclosures, is there a range of effects, a range of estimated effect that you might be able to disclose? If you don't expect the standard to have a material effect, but external stakeholders may hold different expectations, then explicit disclosures of that fact should be considered. On transition to IFRS 15, there's a choice of two transition approaches and a number of practical expedients. To some extent, they depend on the date of initial application. This is the first date of the period in which the new standard is first adopted. So, for example, if you're a December year-end company, you'll be adopting IFRS 15 in 2018. Your date of initial application will be the 1st of January 2018. The two approaches are the fully retrospective approach, under which IFRS 15 is applied to each prior reporting period, with these being restated, or a cumulative catch-up approach, where IFRS 15 is still applied on a retrospective basis, but comparatives are not restated, and instead there's a cumulative catch-up effect recognising equity at the date of initial application, the start of the period in which you first adopt IFRS 15, so 1 January 2018 for December year end. As I said before, comparative information is not restated. There are 4 practical expedients available if the fully retrospective application approach is taken, but only 1 practical expedient available for the cumulative catch-up approach. Looking at the disclosures, IFRS 15 includes specific transitional disclosures, which generally supplement the change in accounting policy disclosures required by IS 8. A company is required to provide an explanation about which practical expedients were used, and to the extent reasonably possible, a qualitative assessment of the estimated effect of applying those practical expedients. If IFRS 15 is adopted fully retrospectively, as I said just now, comparative information will be restated. Normally, IS 8 requires disclosure both for the current period, in which you make the accounting policy change, and for each prior period presented of the effects of the change. However, the IFRS 15 transitional disclosures for the fully retrospective approach only require this information to be given for the period immediately preceding the first period in which IFRS 15 is adopted. So again, if you're December year end, you adopt IFRS 15 in 2018, you're only required to disclose the effect of the change on the 2017 comparatives. You can, if you choose, go the whole hog and adopt the full IS 8 approach and disclose the effect on 2018 as well, and if you give earlier periods on those earlier periods, but you're not required to do so. Under the cumulative catch-up approach, comparative numbers are not restated. Consequently, when an entity uses this transition method, an entity is required to disclose the following information for the reporting period when it first adopts IFRS 15, i.e., again, for December year end for the calendar year 2018. The amount by which each financial statement line item is affected in that year as a result of the entity applying IFRS 15, and an explanation of the reasons for the significant changes in those financial statement line items. So that's the effect not just on the P&L but also on the balance sheet. This means under the cumulative catch-up method, although you're reporting under IFRS 15 in 2018, you're also having to keep a record of what the results would have been under the old approach, so you can make the necessary disclosures for 2018. So 2 sets of books, as it were. One under IFRS 15 and one under IS 18 and IS 11. Moving on to IFRS 9, again there are various transitional provisions for classification and measurement and impairment. It's on a retrospective basis, but you're not required to restate your comparative numbers. For hedging, it's on a prospective basis, but with limited exceptions. As I said just now, you can choose not to restate comparatives and instead just make an adjustment to open-end equity at the date of initial application. Again, for a calendar year end, adopting IFRS 9 in 2018, the date of initial application will be 1 January 2018. When looking at classification and measurement, you use the business model at the date of initial application, e.g. 1 January 2018, but cash flow characteristics at the date of initial recognition of the financial asset. And when looking at impairment of financial assets, you compare credit risk at date of initial application with credit risk at date of initial recognition to get the opening adjustment. There are a number of transitional disclosures. Importantly, these aren't actually in IFRS 9, they're in IFRS 7, since for financial instruments, for IFRS 9, IAS 39, IAS 32, all the disclosures are given in one standard, IFRS 7. And that requires qualitative information to provide an understanding of how the classification requirements in IFRS 9 were applied to financial assets whose classification has changed as a result of applying IFRS 9, and the reasons for any designation or de-designation of financial assets or financial liabilities as measured at fair value through profit or loss. The disclosures include, for each class of financial asset and financial liability at the date of initial application, in a table, unless another format is more appropriate, the original measurement category and carrying amount determined in accordance with IAS 39, and the new measurement category and carrying amount determined in accordance with IFRS 9. In addition, the amount of any financial assets or financial liabilities that were previously designated as fair value through profit or loss, but are no longer so designated, distinguishing between those that are required to be reclassified and those which an entity elects to reclassify. For instruments that are reclassified so that they're no longer measured at fair value through profit and loss, but at amortised cost, or for financial assets where you can choose to at fair value through OCI, an entity needs to disclose the instrument's fair value and fair value gains and losses that would have been recognised if it had continued to be carried at fair value through profit and loss, the effective interest rate as well as the interest revenue or expense actually recognised. So quite a complicated set of disclosures there to be made. Moving on from IFRS 15 and IFRS 9 to other news items. Since our last webinar in November last year, the Financial Reporting Council has published its annual review of corporate reporting and also the results of the 3 thematic reviews. The thematic reviews are around judgments and estimates, alternative performance measures, and pension disclosures. And the thematic reviews are quite useful because they provide a number of examples of better disclosures which the FRC has come across, which illustrates how companies could address findings in the review. It can be assumed that over the course of the coming reporting season, the FRC will continue to focus on areas covered by these 3 thematic reviews, together with the other matters highlighted in the annual review when they look at the company's annual accounts in 2018. Some of the key messages coming out of thematic reviews: judgments and estimates should be separately identified, and this is something the FRC has mentioned a number of times. The disclosures in IAS 1 look at judgments not requiring estimates and those requiring estimates separately and have separate disclosure requirements for each. And the FRC would like to see these disclosures around judgments not requiring estimates and estimations dealt with on a separate basis so it can be sure that the relevant disclosures have been provided for each. There should be detailed descriptions of the specific material judgments made by directors in applying accounting policies, and where there are no judgments that are significant enough to require disclosure, it's helpful to state that fact. The reasons for any changes in judgments disclosed from year to year should also be explained. Estimation disclosures should focus on those where subsequent re-estimation will give rise to a significant risk of a material adjustment to the carrying value of assets and liabilities within the next year. Information about longer-term uncertainties may be useful for users of financial statements, but these additional disclosures should be clearly identified and explained. And again, the reasons for changes in estimates disclosed from year to year should be explained. As regards to alternative performance measures, key messages coming from that was that all additional performance measures should be provided and labelled and accurately described so that it's understandable when they're being applied. Where terms such as non-recurring are used, they should be clearly justified and accurate. The FRC found some instances of non-recurring measures actually recurring, and are very upset about that. Companies should set out clear explanations why they've chosen to use APMs, and in addition to the normal IFRS numbers. There should be reconciliations to the amounts appearing in the financial statements for each APM disclosed. And APMs should not be displayed with greater prominence than the measures directly stemming from the financial statements. Again, if there's a change in APMs, it needs to be flagged and the reason for that change disclosed. On pension disclosures, the thematic review interestingly suggests that information in addition to that required by the standard IAS 19 should be provided where it's necessary to understand the risks associated with the pension scheme, how it may affect the amount, timing and uncertainty of the company's future cash flows. Where a net pension asset has been recognised, or it appears that required future contributions may create a surplus, there should be an explanation of the judgments made when assessing trustees' rights around the recoverability of that surplus. The annual review picked up on a number of areas, including accounting policy disclosures, the effect of the adoption of IFRS 9, 15 and 16, which we've already touched on, business combinations. It's noted that this can be a complex area, and in particular disclosures around estimation uncertainty on measurement of contingent consideration, completeness of intangible assets, other than goodwill, and the treatment of contingent consideration linked to future employment should be considered. And on cash flow statements, the FRC noted it's important that cash flows are actually presented as operating, investing, or financing. Having announced the thematic reviews from last year, they've also recently identified what the next thematic reviews will be. So they're going to be looking at targeted aspects of smaller listed and AIM-quoted companies' annual reports, looking at the effects of IFRS 9 and 15 on 2018 interim accounts, and we touched on that earlier about the expectations around disclosures. The expected effect of IFRS 16, which comes in for periods beginning 1 January 2019, the effects of Brexit on companies' disclosures of principal risks and uncertainties. On the smaller listed aspects, the 5 topic areas they've identified in particular are strategic reports and alternative performance measures, accounting policies including critical judgments and estimates, cash flow statements, tax disclosures and pension disclosures. So these areas, together with the ones we just mentioned from the previous thematic reviews and the annual reports, are likely to be matters that the FRC has particular attention to in their routine monitoring programme going forward. They've also mentioned their priority sectors for next year, which will be financial services, with particular emphasis on banks, lenders and insurers, oil and gas, general retailers and business support services. Moving on, for AIM companies, the London Stock Exchange has recently consulted on proposed rule changes that would require AIM-listed companies to comply or explain reasons for non-compliance against a recognised corporate governance code. However, these disclosures will be made on the company website, not in the annual report. The proposals of a change to AIM Rule 26, which would require disclosure on the company's website to include details of a recognised corporate governance code that the board of directors of the AIM company had decided to apply, how the AIM company complies with that code, and where it departs from its chosen corporate governance code, an explanation of the reasons for doing so. There's no explicit requirement that this should be an annual statement on the website. However, all AIM Rule 26 information, and this is a list of information that AIM companies need to keep on the website, should be kept up to date, and the last date on which it was updated should be included within the website. The proposals do not require disclosures in the annual report, although many recognised governance codes do require some annual report disclosures, so that needs to be borne in mind. Nor do the proposals specify which recognised corporate governance code should be used. So as now, it will be possible for AIM companies to report against the corporate governance code for small and mid-sized quoted companies published by the Quoted Company Alliance. The changes were set out in AIM Notice 49. The consultation closed at the end of January, and the changes are intended to take effect from the 30th of June. In addition, there's already been a change as regards AIM Rule 26, and that basically means that going forward, the requirement to keep copies of various documents is now for 5 years rather than the 3 years it was previously. This is a consequence of AIM being registered as an SME growth market on the 3rd of January. In our November webinar, we spoke about the government plans on corporate governance. Following on from that, the FRC has consulted on proposals for a revised UK Corporate Governance Code to reflect the changing business environment to help UK companies achieve the highest level of governance. It also reflects the findings in the FRC's report on corporate culture and the role of boards, published back in July 2016. The proposed revised code focuses on the importance of long-term success and sustainability, addresses issues of public trust in business, and aims to ensure the attractiveness of the UK capital market to global investors through Brexit and beyond. In developing the proposals, the FRC has engaged with many stakeholders and incorporated suggestions from the government's response to the Green Paper consultation on corporate governance reforms. If finalised and proposed, the revised code would be shorter and sharper, with supporting principles being eliminated and a number of provisions being reduced. The proposals also feature some significant changes to the code structure. To compensate for all of this, the proposed revisions to the code are accompanied by proposed revised guidance on board effectiveness. The consultation closed on the 28th of February, and the FRC aims to publish a final version of the code by early summer 2018 to apply to accounting periods beginning on or after 1 January 2019. The proposed code sets out good practice so that boards of companies can establish a company's purpose, strategy and values, and satisfy that these and their culture are aligned, undertake effective engagement with wider stakeholders to improve trust and achieve mutual benefit, and to have regard to wider society, gather views of the workforce, ensure appointments to boards and succession plans are based on merit and objective criteria to avoid groupthink, promote diversity, be more specific about actions when they encounter significant shareholder opposition on any resolution, including those on executive pay policies and awards, and give remuneration committees broader responsibility and discretion for overseeing how remuneration and workforce policies align with strategic objectives. And then finally, if you've got a US tax presence at all, there's a change in US tax law which was signed into law just before Christmas on the 22nd of December. So it's now been enacted and needs to be considered for December year ends when thinking about deferred tax. The changes include a reduction in the tax rate from 35%, this is talking about federal tax, reduction in tax rate from 35% to 21% for tax years after 31 December 2017. We've already seen a number of US organisations reporting large charges in their quarterly statements as a result of this, as they write down deferred tax assets to reflect the lower tax charge. Also for US companies as overseas investments, there's a one-off mandatory repatriation tax on certain accumulated earnings and profits of investments in specified foreign corporations, which applies to earnings and profits at either 2nd of November 2017 or 31st of December 2017, whichever is the greater. Again, that's given higher sort of current tax charges. So there's changes which need to be considered now if you've got a US tax presence, perhaps you've got a US subsidiary, or you've got a US subgroup. You need to consider the effect now for December 2017 or later period ends.